Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I'm going to walk you through the process of valuing Nxt-ID stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or sell. Nxt-ID provides technology products and services for healthcare applications. It has extensive experience in biometrics, identity verification, security, and encryption technologies. It has two subsidiaries, LogicMark and FitPay. LogicMark is a manufacturer and distributor of personal emergency response systems. FitPay develops touchless payment devices. Let's get started with the model. This is a micro-cap company. 32 million market cap. They're trading at 92 cents a share, and they have 35 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And the company has negative free cash flow in 2017 and 18, but positive in the next 2 years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have negative net income every single year. Their revenue doesn't look so great. It's declining. It goes from 23 million to 13 million. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. So each year they do have positive gross profit. Below that is operating expenses. And they did have positive operating income in every year except 2017. They also have to pay interest on their debt. It looks like that's decreasing. It was 7.7 million in 2017, then 2.3 million in the trailing 12 months. That's a good sign. But they do have negative net income every single year. This is the statement of cash flows. The top line is the operating cash flow. That's how much money the company generates from its operational business. And here's the capital expenditures. These are the investments in property, plant, and equipment. And operating cash flow minus CapEx gives you free cash flow. They did have positive free cash flow in the past 2 years, which is good. And it looks like they're paying down more debt than they're issuing. In 2019, they issued 15 million and paid down 20 million. In the trailing 12 months, they only issued 346,000 and paid down 2.2 million. But it looks like they're also funding their business on capital stock. They issued 13 million in 2017, then 3 million in 2019, then 1.9 million. This is the company's operating cash flow. In the trailing 12 months, they did have negative net income, but they operated with positive cash flow because depreciation is an expense on the income statement. That's a non-cash item. So is stock-based compensation, another expense that's a non-cash item. So it is good to see that they're operating a positive cash flow. Let's hope that continues. Let's look at the capital structure. $9 million of equity, $12 million of debt. So they have more debt than equity. Their net debt is $10 million. That's debt minus cash. And their WACC is 12.3%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year, that's 36 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $34 million. We divide that by 35 million shares. And we get a calculated stock price of 97 cents. They're trading at 92 cents, so they're trading at a 5% discount. It is a buy according to the model. Simply Wall Street's at $1.16, so they're saying the stock is 20% undervalued. This is the stock price the last 5 years, so it is hard to tell how they've been doing because they did a 1-for-10 reverse stock split in 2016. So you'd have to divide these numbers by 10 to figure out where they were actually trading at these time frames. This bottom chart is the stock price the last 12 months, so you can see it was pretty steady at about 50 cents for a while, then shot up yesterday to 92 cents. If you invested $10,000 when this company IPO'd in 2013, you'd have $157 today. This company actually has a negative beta. That means the stock moves opposite of what the market moves. And in the past 52 weeks, they're down 4%, while the S&P is up 16% in that same time frame. Their 52-week low is 21 cents, and the 52-week high is $1.07. Their 200-day moving average is above their 50-day moving average. That's considered the death cross. That's not a good sign when that happens. But the stock is currently trading well above its 50-day moving average and 200-day moving average, so it's in a big uptrend. The only reason is because the stock doubled in price yesterday. It has a pretty low trading volume, about 4.5 million shares get traded per day. And of the 35 million shares, 30 million are on float. Only 13% are held by institutions. And less than 1% of the shares are shorted, which is a pretty low short percentage. This stock was traded more than any other stock yesterday. 126 million shares changed hands. The reason the stock was traded so much is because Bitcoin hit $20,000. And this company offers the Wallet. This is a smart wallet where people can store their money virtually online. This company also makes a digital credit card. So this stock may go higher and higher, especially if Bitcoin and other cryptocurrencies keep going up. Let's look at the financial ratios. The average PE in the market's 12, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 2.5, so they're doing really good in that ratio. Price to book is stock price over book value per share. They're at 3.8, so they're also doing well in that ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. And they have $9 million of equity on a balance sheet, but negative $15 million of tangible equity. So they have a lot of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense, so they cannot cover their interest payments with their EBIT. ROE is net income over equity. They have negative net income, so negative ROE. Current ratio is current assets over current liabilities. They cannot cover their current liabilities with their current assets. Their current assets are 1.6 million of cash and 1.3 million of inventory. So in the trailing 12 months, they did have positive free cash flow, but they currently have negative 2 million of working capital. If they also generate 1 million of free cash flow this year, they're going to need more debt or equity to run the business. But I have a feeling they're going to start generating a lot more cash flow, especially if they can capitalize on the virtual wallet and the virtual credit card. And I don't have anybody to compare this company to. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.